One of the biggest fears that first-time homebuyers have is where to start in the process, or maybe even how to even get started.
Yeah, I mean, it seems very daunting to start with a mortgage pre-approval, but it is probably the most important part of buying a house.
We are the Hemry-LaSalla Group. My name is Glenn, and we are a lender here in Southern California, and we are family. And what's really important to us is making certain that every one of our clients, that they're treated as though they were family as well.
Yeah, my name is Mike. This is actually my father-in-law. We work hand in hand together. But if you have any comments on this video, drop them below. Give us a like, that goes a long way for us. And if you want to subscribe to future content, make sure to hit this button right here.
So getting pre-approved, where do we even start? So a lot of people will go to social media or online. They'll look at realtor.com, they'll look at Zillow, they'll look at Redfin. Maybe they're even meeting a realtor at an open house on the weekend and they're jumping in the car and they're out looking at homes.
Yeah, but this is sometimes the biggest mistake that we see people make, because it's most important to know what you can get approved for and really what you're comfortable paying, right? We don't want to be looking at homes that we can't afford or we're not comfortable with the monthly payment. So it's most important to start with a mortgage pre-approval. And now, yes, it can be daunting, right? Your loan officer is probably going to know more about you than you know about yourself, because he's going to be looking at your income, your financial statements, but it is an important part of the process and really determining what you can get approved for.
And at the end of the day, one of the most important things for us and our team is we want you to be worrying about finding your dream home, not worrying about affording your dream home. Let's start with what lenders look for when they're qualifying you for a mortgage. And for the purpose of this video, let's just break it down into three easy categories: income, credit, and assets. So Mike, let's start with income.
Yeah. And there's a lot of different types of income that can actually help you qualify for a mortgage. But let's just start with, what is your gross income, right? Your gross income is your income that you receive before taxes are taken out. So I know a lot of times when we're looking to qualify people, they look at their net. And now that's important when creating a budget, but we look at your gross income when actually figuring out what you can get approved for. So when this comes to W-2 income, right, you work for an employer, you either have hourly or salary wages. Those are very easily to calculate off of your most recent pay stubs. Now, if you receive income types like bonus, commission, or overtime, we're going to look at a longer history because those can vary from month to month. And we want to calculate an average based on what you have received in the past for those types of income. So if you're changing jobs, make sure that's an important part, right, of your income calculation, is that bonus and commission. Now, if you're self-employed, right, we get a lot of questions about self-employed income, and there's a lot of ways to actually qualify people. The most traditional way is looking at your most recent 2 years of tax returns. We look at that gross income minus your expenses, so the net income that you are actually paying taxes on is what we're able to use as qualifying income. Now, keep in mind, there are different programs like bank statement loans for self-employed borrowers that help in terms of really expand that approval of what you can be looking for.
A lot of times it's looking at that tax return and really doing a thorough analysis of the tax return, because there's things that you might be writing off that maybe we add that back in and it helps you qualify. So sometimes when we're looking at qualifying, sometimes maybe we look at these numbers and maybe it doesn't quite get you to that level or that purchase price that you really want to get to. So, there's co-signers that we can look at that can help you qualify for the loan. Maybe it's your household, maybe it's family that's living with you. If they're on the loan, then that's income that will help you qualify. We also have something called a non-occupying borrower, where they don't have to live with you, where we can add their income and their liabilities to yours and help you qualify for a mortgage. So there's a lot of options around this income piece that a lender that is very knowledgeable in the industry and knows guidelines can help get incomes to help you qualify.
Yeah, and let's not just break it down and keep it narrow, right, to W-2 or self-employed income. There's a lot of other income types that are able to be used, right? There's child support, alimony, there's auto reimbursements that you receive, there's capital gains. Maybe you have rental properties that you're collecting income from. These are all different types of incomes that we'll be able to look for. And if we have the appropriate documentation, then we can use this to help in your mortgage pre-approval.
That's right. And there's a lot of different income sources, as Mike's saying. And, a lot of times we look at employment history, also someone that maybe just getting out of school and just starting in the workforce, they feel like, oh, I can't qualify. But in reality, we can use that schooling to help qualify you. There's Mike mentioned bank statement loans. There's programs that we have available to us that will help you qualify where maybe you don't need 2 years of work history. Typically that's what we want to see, but it's not a hard and fast rule. It's like something that you need to, once again, be confident in the lender that you are working with to help you through this process and answer these questions that you have, that you might be putting yourself out of a mortgage before you even start because you think you don't qualify.
Next up, let's talk about credit and credit requirements. So your credit score is a big part of qualifying for a mortgage, but it's not the only component of credit. Now, every loan program is going to have a different credit score requirement in terms of that minimum credit score that's needed for that program. So take a look at this page right here. It'll break down the different loan programs from FHA and VA to conventional to USDA to jumbo loans and what the minimum score is for those programs.
And a lot of times what you're looking at is when you're looking to apply for a mortgage, you're thinking of your credit score and you don't want to have an inquiry show up on your credit score. You don't want to hurt your score by applying for a mortgage. So there's a soft pull and then there's an actual hard pull or hard inquiry on your credit report. When you start the application, we could actually work off of that soft pull where it doesn't affect your score. It's basically taking a snapshot of what your credit. We can really work from that and we can help you with the numbers. And then once it starts to make sense and we're moving forward, then we can go ahead and do that hard inquiry, because the reality of this is that you are concerned with your score because you are saving it for the biggest purchase that you make in your life. And that's right now that you're purchasing your home. So let's look through the numbers. And then when we're ready, we can do that hard inquiry. It's really just a small reduction in points for a short period of time on your credit score. Now, there's a lot of different algorithms that also go into this. And when you look at, maybe you have Credit Karma, maybe you're looking at something through your bank where you're seeing what your credit score is. And those are great indicators of what your score is, but that's not your actual score. When we do your mortgage credit report, it's a different algorithm. We're going to pull all three credit bureaus. We're going to take that high score and low score. We're going to use the middle score. A lot of people think it's the average, but it's actually whatever that middle score is. So that's really the one that we're working with to approve you for your mortgage.
Yeah, and the thing that we get a lot is people that come in, right? They've kind of being excited about purchasing a house because their credit score may be lower. And that's where we work with a lot of people with the credit simulators. So the important thing is to not do steps that you may not know are the right steps. And that means paying off debt. And kind of, we have a lot of people that walk to us and they're like, we paid off all our debt. We're ready to finally go. Well, little do they know, right? They closed accounts that impacted their credit score. So what we want to have is that credit report so we can run credit simulators to be able to go over and figure out what is the best debt to be paid off for you and also for your home purchase. Because the biggest thing that we look at is what's called your debt to income ratio. So your monthly liabilities in comparison to your gross income. Now, just like the credit scores, there's different requirements for each loan programs. There's different requirements for each loan provider that you work with. So whether it's a bank, a direct lender, a broker, everyone's going to have a different kind of requirement there. The best rule of thumb is somewhere between 45 to 50% for your overall debt compared to your gross income.
And if you're running this calculation on your own and you're thinking, oh, I have to go and pay off this debt, let's not do that, because maybe that money can be used for your down payment, whereas it didn't really help you by paying off that debt. For example, if you have a loan that has a low monthly payment versus an account that maybe has the same balance but has a higher monthly payment, like if you had a car payment that was $700 a month, if you were to pay off that debt, that actually gains you $100,000 in purchase power. That's a game changer.
Yeah, that's huge. And I think a lot of people just want to have that debt gone. And sometimes peace of mind, that's worth it, right? But we want to make sure it's kind of helping you in your home purchase as well and using that cash in the best way to help you buy a home.
This goes back to, like, we want to help you worry about making that payment, not worry about affording that payment. And this is something that we can do to help.
Yeah, of course. And the last thing we want to touch upon in the credit section is your student loans. These are a big thing, a big hot topic, because ultimately people think when they have student loans that they can't qualify for a mortgage. Same thing with credit cards, right? Just because you maybe have a larger balance doesn't mean it's going to take you away from qualifying for a home, because we look at the minimum payment required on those debts. Now, a student loan, right? There are ways, even if you haven't been deferment or forbearance, we're going to use a minimum payment to help calculate what those payments will be moving forward, but it is not not a hindrance to purchasing a house. So don't expect that, right? Be able to qualify with your student loans. Let's talk about the cash.
Show me the money.
Yeah, there's got to be some money to purchase a house, right? So every loan program, just like with the credit score, has its own requirements for the minimum down payment required. Now, this is based off of the purchase price of the home. So on an FHA loan backed by the government, this is a minimum down payment of 3.5%. Now, a VA loan, the best benefit for a veteran out there, could do 100% financing, meaning you don't need a down payment and you can avoid mortgage insurance on your loan. Now, a conventional loan is going to be anywhere from 3 to 5% of the purchase price, depending on the area that you're purchasing. And then also every county, every state has different down payment assistance programs that can help a lot of first-time home buyers getting into homes.
Exactly. And now we're talking about percentages here, and Mike's bringing up some numbers here for us. And a lot of times our clients come to us and they're like, I want to put 5% down, but that's the down payment. We have to recognize that there's also closing costs that are involved here too. So we like to figure about 1.5% to 2%. Easy math is 2% of the purchase price is what you would be looking at as far as closing costs. Now, closing costs, we kind of lump that together. That's going to be cost of you actually getting the loan. And then we have what are called prepaid expenses. That is setting up your impound account so that your taxes and your insurance gets paid when those become due. You're making one mortgage payment to your lender, and then the lender is taking care of those impound accounts for you. So figure about 2% is a good number for you to cover closing costs.
Yeah, and you touch upon a good point, right? Like not all lenders are created equal as well. So depending on whether you're working with a direct lender like us, right, we don't charge any points to do the loan. And a lot of lenders will disclose points, and points are a cost to buy down the interest rate. Now, some lenders may charge points just to do the loan. So you may see those closing costs actually be higher. And that's kind of a red flag, right? To be able to look around to different lenders to make sure you are getting kind of what you're being offered and not something that's overly expensive for the house that you're buying. Now, taking a look at an example, right? Let's just say we had a $500,000 purchase price and we're putting a 5% down payment. So now that purchase price or that down payment would be $25,000. If we use 2% for closing costs, that would be $10,000. That would mean the total cash that would be needed would be $35,000.
So now we talk about how much you need. Now, where can those funds come from? There's a lot of different accounts that are eligible accounts. There's some that are not. We could use a 401k or a TSP account that you might have set up for yourself. You can actually take that money and use that for your down payment or closing costs. That can be in your savings account. It can be in your checking account. It can be in a money market account. So there's a lot of accounts that are available for you. And what we're looking at is most likely the most recent 2 months of those asset statements. And what we as a lender are looking for is any large deposits. So sometimes we'll see a large deposit. We're going to question where that came from. Now, some of those large deposits, that might be your paycheck, could be that, or it could be cash that you have at home. So this is a big one that we come up against. The money that you have in your bank accounts needs to be what we call seasoned. So sometimes we see a large deposit in the account. It's cash that you had saved at home. Now, some programs will allow for this. Some programs will not. And it really depends on where did the money come from? And that's what we were really looking for is where did it come from? Did you take out a loan for it? Did you sell a vehicle to get that money? So like I said, a lot of different options here and something that we can definitely look at. And we also have gift funds as well. That's something that is an acceptable source of funds as well.
And I would say that's probably the most common source for a lot of people right now, outside of retirement accounts and your normal savings, right? Gift funds, family that want to help and see you purchase your first house or your second house, right? So gift funds are definitely an eligible source for most programs, depending on how you plan to occupy the property. They'll have different requirements around that, but this can come from a relative, right? Brother, a mom, a dad, an aunt, an uncle, a grandma, right? These are all eligible sources for those gift funds.
Something that we would say to you is one of the biggest pieces here is don't transfer the money yet. If the gift funds become an option for you, just know that the gift funds are available because we're going to want to see like how much is it. And then once you're in escrow, that's when we can talk to you about how to transfer those funds because there's an easy way, there's a hard way. We like the easy way.
All right, so we touched upon upon your income, your credit, and your assets, but now we actually need to document this and verify it. I know it could be the cumbersome part of the process, but it is a necessary evil. And now, while you're doing the application, you could potentially digitally verify your income, depending on your employment type, or digitally verify your assets. This helps really limit the amount of documentation that we may need because it's already verified. Now, keep in mind, there are certain documents that will be needed if this doesn't come through verified. So this could be like 30 days of pay stubs, most recent 2 years of W-2s, and most recent 2 months of bank statements. And now if you're self-employed, it will be your most recent 2 years of personal or business returns, and potentially multiple months of bank statements, depending on the loan program that we're looking at.
So one thing that we like to do is we like to decision your loan first and document second. So Mike's giving you like a laundry list of items that we need. But if we're not able to digitally verify your information and we're able to decision your loan, that decision might give us a reduced list from what Mike just mentioned. So we might be able to simplify that. And I think that that is a big piece of, your lender shouldn't be just giving you this laundry list of items that they make you go and chase, and then they get these documents and they may or may not need them. So very important for your lender to be up on technology of today. So, and now how do we get these documents? So a lot of lenders will have a portal, and this is very important piece for you as well in that, for example, we have a secure portal. Like email is not 100% secure, and everyone wants to just email documents. So although that's very simple and easy, we don't like to do that because your privacy and your personal information is very important to us, and we want to make sure that we're protecting that at every step along the way. So we put tasks together for you and tell you exactly what we need, and we put that out in our portal, and then you upload your documents directly from your portal. That could be from your smartphone. It's a very simple process for us to collect your documents. So just make sure, once again, that the lender that you're working with is up on technology and they're collecting your documents in the right way. So in closing, I think the most important piece of everything that Mike and I are talking about here is it's really you feeling comfortable with the experience of the lender that you're working with. I think that is probably the biggest thing. If you trust this person to help you through the biggest purchase that you make in your lives, then you're off on the right foot.
Yeah, I think we talked about it in the beginning, right? Your loan officer will probably end up knowing more about you than you do yourself. So it's important to know who you're working with, that you trust them with your information, that you feel comfortable moving through this process. And keep in mind, right, you have time to shop for a mortgage. When you actually pull that full credit report, it's not that you're one and done, right? There's a time period where you can actually shop around for different mortgages, and only one of those credit inquiries actually impacts your score. And we get a lot of people that come to us, whether first-time home buyers or they're renting, right? And they come when their lease is expiring. Well, we want to keep in mind that sometimes this process takes a little bit of time. Maybe we need to build your credit up, or we need to work on down payment savings, and we're not quite ready at that initial application. So we don't want you to wait till the last minute and then you have to renew your lease, because that happens all too often. And we end up renewing our lease for another year, and now we've missed out on these appreciation gains and savings that you're building by paying your principal down on your mortgage. We want to get you into that property when you're ready and comfortable to do so.
Exactly. And through this shopping process that you're going through here, every lender can have what we call overlays. And basically what an overlay is something that maybe that lender is adding on. It's additional information from you that is being required for you to supply that, another lender might not need. So these overlays are just protection for the lender. It's just them getting that comfort level in your application. So, this is an important piece too. Like, you don't want to be supplying all of this documentation. And sometimes as lenders, this is where a consumer kind of gets tripped up and they're like, well, they keep asking me for documentation. And it very well could be these overlays.
Yeah, and these overlays, the bigger impact can be also is that not all lenders are created equal, right? You may be approved at 500 with one lender and 550 with another. Well, it's important to know what actually went into that approval, why there are differences in the approval amounts, and sometimes it has to do with guidelines or how they calculated a payment. That's where it's okay to look at multiple lenders and don't feel like you're trapped with the original lender that you're working with, especially if you're not getting the communication that you deserve.
Exactly. And our hope for you is really to help you through this process on your home buying journey. So We hope that you find this valuable and, reach out to us if you have questions or if there's anything further that we can answer for you.
Yeah. So if you like this video, you enjoyed it, right? Put a comment below, give us a like, tell us what you enjoyed. If you want to know more information about a specific topic in this video, definitely follow along for these future videos that give us a little bit more intel on the mortgage process.
We are the Hemry-LaSalla Group.